I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. No more playing it safe. Investors stop doing the safety dance and slide back into risk mode in the final months of 2019. Former AllianceBernstein chief Peter Krause is known as the man who hates ETFs. Well, he's found a way to save mutual funds, and it has to do with fees. And a new Green Deal? This week's There's an ETF for That features a fund for investors who want to build a green economy. Now, love 'em or hate 'em, ETFs are here to stay, and Eric Balchunas gets up early. He stays up late to watch their flows to get a read on broader market trends. What do you see, Eric?
Thank you, Scarlet. I do, and we're on our third week of what's really a complete risk-on attitude. We've tried to not fall for this. Sometimes we've seen these head fakes, but it seems pretty legit since basically the month of November. So let's look at the last week. The Qs, right? That's a tech play. There's international, right? International has really not caught a bid all year. Now it's coming back. Financials, right? You've got to have cyclical sectors. Then you have discretionary. You've got Europe. That's been struggling all year. And also look down here at value. Value is sort of trying to take over for low vol and take over the factor world. That's another change. Let's look at the outflows to see what's coming out. Now, SPY is at the top of the list. Normally that's bearish, but I think this will turn green next week. I'm going to discount this for now, but I'm going to look at GLD outflows. That's again bullish. TLT outflows, right? These two really led sort of that safety dance, as Scarlet called it earlier. And also look at down here, USMV. This was the golden boy of the year, right? Now it's seeing outflows because value's trying to eat into it. So let's actually look at low vol, gold, and fixed income, which is our safe haven ETF flow index, breaking them all out. And look at this. The first time in a long time, all three of those categories have seen outflows. So, Scarlet, investors are clearly shedding any sense of needing to hedge this rally. So I'm almost ready to call it a regime change.
Well, we've had quite a few of those this year. Let's bring in Dan Egan. He's Managing Director of Behavioral Finance and Investing at Betterment, and Vildana Heinrich, who covers ETFs for Bloomberg News. Welcome to both of you. Dan, it is back to risk on. The latest Bank of America Merrill Lynch fund manager survey shows that cash levels are at 6-year lows. What are you seeing when it comes to positioning among Betterment's clients?
I think one of the things that we can get caught up in is that retail clients and people, a lot of the sort of Main Street money will react a little bit slower than we would take for granted. And so one of the things that we're seeing is that the Fed has been lowering rate. That's trickled down through bank rates to the point where most people are seeing a 1.7% yield on a high yield savings account. The implication there is that customers are actually running away from an account that's not going to keep up with inflation and looking to take on risk somewhere. So I think it's less of a bullish indicator and more of a, oh, I have to get the yield from somewhere.
Gotcha. All right, so that hunt for yield continues. Vildana, you reported on a story that looks at the rotation out of the safety trade and into riskier pockets of the market. What are people saying on whether this is fleeting or something more permanent?
The majority of people I've spoken with are saying that it does have room to run. And it's really a function of improved economic growth, the U.S. and China coming to a trade deal. The Fed has cut 3 times already. Maybe they're engineering a soft landing for the economy. So a lot of people are saying we're going to continue to see cyclical value plays benefiting as more and more people start to jump into the stock market and try to keep up with its gains.
So, Dan, one of the ETFs has been really just climbing the leaderboard all year is BNDX. It's the Vanguard International Bond ETF. It also happens to be Betterment's biggest purchase of all ETFs in your last 13F. So, this thing is interesting. Look, it ranks 4th in flows, but it's 36th in assets, so punching way above its weight. What is the appeal of this? Did they not have international bond before? Why is this doing so well?
BNDX to me is one of the greatest cases of the ETF industry really innovating and listening to clients. So what is BNDX? There were funds out there that would give you international bond exposure before, not as broad-based and critically, not with a currency hedge built into it. At 9 basis points, and I believe it started out higher, and Vanguard has lowered the expense ratio over time, 9 basis points, you can get exposure to all developed international bonds, all fully currency hedged. And the important thing there is that without that currency hedge, this is a bond fund that has the volatility of a stock fund. With the currency hedge in place, it looks a lot more stable. And the returns have been wonderful. Actually, having the ability to have a diversified interest rate move basket works for clients.
And perhaps they were diversifying away from the U.S. Vildana, you were looking at flows in and out of the vanilla bond fund, long bond ETF, TLT. What do they look like? What does it tell us about what the prospects are for TLT?
massive outflows last week. We saw investors pull more than $1.2 billion from TLT last week, and that was a record week of outflows. We're continuing to see outflows this week. About $50 million has come out, again going back to investors betting that we're going to continue to see improved economic growth, the US and China coming to a trade deal. So it'll be really interesting to track that one going forward.
All right, we're in mid-November right now, Dan, and we're approaching year end. And if you look at the 2019 stats, the numbers are pretty incredible for the major indexes. But at the start of this fourth quarter, I kept hearing from people about the December meltdown at the end of last year. You're an expert on investor behavior. Is there an extra level of nervousness that history might repeat itself this year?
I don't think so. I think the real thing that we're looking at right now is that this is a year where a lot of mutual funds are going to be distributing capital gains to their holders. And if you can get out of a high fee mutual fund that's about to hit you with a capital gains distribution, now's a good time to do it. So I think it's a little bit more. There's end of year stuff that investors are doing to prime themselves to be in a better position next year.
Now, Vandana, regardless of the economy's prospects, there is a secular shift that we've seen into certain kinds of funds, namely ESG funds. What have you seen?
Totally the opposite of what we were seeing from TLT. We're seeing massive inflows into ESG funds, about $6.8 billion so far this year, which puts it on pace for a record year of inflows. And it's about triple what we were seeing even just a year ago. A lot of retail investors like it. Institutional players are jumping in. But I do want to point out that the majority of those inflows are coming from just a handful of players, USSG and SUSL.
Dan, you claim that ESG investors are better investors. I personally think a lot of them are slacktivists, and they will leave as soon as the performance isn't there. Prove me wrong. What are you saying?
So back when Henry Ford first started making his cards, he said you can have it in whatever color you want as long as it's black. But you'd be surprised how much it matters to people that they can personalize and customize, put their personal stamp on their possessions. This works in the stock market too. People are going to stick with, they're going to be happier with a fund that represents their values and interests. It might be a little bit of lipstick, but nonetheless, they're going to be better behaved and stick with it through down markets because they believe it's doing more good than just making money.
Even if they underperform the S&P?
Absolutely.
Okay.
All right, so maybe not slacktivists, Eric. All right, our thanks to Dan Egan of Betterment and Bloomberg's Vandana Heirig. Appreciate it. Now, coming up, we've got Peter Krause, Chairman and CEO of Aperture Investors and the former chief of AllianceBernstein. He tells us about his plan to save mutual funds. And one ETF trend that caught our attention this week is tied to emerging markets. Optimism about a trade deal encouraged investors to add money to EM ETFs last week at the fastest pace in 9 months. This marked the 5th straight week of inflows, and so far this year, inflows have totaled more than $3.6 billion. And a reminder, you can catch all our charts on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Food. This is Bloomberg ETF IQ. Let's take you through the ETF life cycle, which has 3 main stages. And step 1 is the filing. Direction wants to add to its suite of funds with 150% long and 50% short exposures. It's filed the Direction MSCI USA ESG Universal Movers versus Laggards ETF, which will go long companies with high ESG scores and short those with low scores. Step 2 is the launch. The Microsector's FANG Plus ETN begins trading this week. Ticker FNGS will be an unlevered play on the New York Stock Exchange FANG Plus Index. It's part of Microsector's other variations on this index, including 3 times levered long and short ETNs. And for some, the final stage is liquidation. Insight Shares is winding down its Patriotic Employers ETF and its LGBT Employment Equality ETF. Both are principles-based funds with honor investing in firms that encourage veteran workplace participation and pride targeting companies that support LGBT workplace equality. It's time now to get passive aggressive, where we track the tensions between active and passive investing. We know investors are less willing to pay up for market exposure when they can get it at low fees through an index fund or an ETF. Enter former AllianceBernstein chief Peter Krause. His new firm, Aperture, is shifting the pay model with performance-based fees. And Peter joins us now. Great to see you.
Good to be here, Scarlett. Thanks for having us.
So you are a 30-year veteran of the asset management world.
I am.
And you started your new firm, Aperture, about a year ago, just over a year. Mm-hmm. How long had you been thinking about this idea of linking pay to creating alpha?
That's a really good question, because it's been about 5 years in the making. You know, about 5, maybe even 6 years ago, I started thinking about what is it in the active space that is challenging performance so persistently? Because we know when we look at the large numbers across many different managers, and specifically U.S. equity managers, that managers don't perform net of fee. And I kept saying to myself, why is that? Is there a structural reason? Is there a cyclical reason? And ultimately, I came to the view that size really matters. And the more assets you have, the more challenging it is to perform. And the incentive system that the industry was based on for 50 years rewards size, both to the PM and to the firm. And so if you wanted to actually change the probability of having good performance, you had to attack the incentive system.
And that's exactly what you did. So what kind of managers are you now recruiting at Aperture? What is their incentive for working at your firm versus a traditional mutual fund where they're not on the hook for a bad quarter or a bad year?
Yeah, great question, really good question, because you're getting at the heart of what Aperture is trying to change. The existing pool of managers are effectively an incentive system that produces adverse selection. You get paid whether or not you perform. Aperture is creating a pool of managers that has a positive selection bias. You get paid if you perform. There's a modest base fee and a modest base salary, but virtually all of the compensation to the manager comes from performance. So managers at Aperture really want to perform and believe they can perform and have a history of actually doing that.
Okay, so when we look at your first two funds, the Aperture Endeavor Equity Fund and the Aperture New World Opportunities Fund, you said there's a base management fee that's fairly modest, and then a performance fee once the fund outperforms its benchmark. 40 basis points, or 44 basis points in this case, is cheap for a mutual fund. It's in line with the average ETF. Of course, if you asset weight the fees for equity ETFs, that would be 15 basis points. So is this base management fee enough to keep investors from switching into passive products like an index fund or an ETF?
Yeah, great question again. So first of all, ETFs, as you know, because you're a specialist in them, are all different in different kinds of parts of the market. And so the Endeavor Equity Fund is focused on the global equity market. Lower ETF fees are usually in the U.S. large cap space. So if you look at the global equity market, the 32 basis points is basically the average of those fees. Secondly, ETFs have tracking errors. Tracking errors are really big deals. People don't talk about tracking errors. You don't actually get the index return. You get the index return minus the fee minus the tracking error. And in the case of the global equity world, that tracking error can be 30 to 35 basis points. So you're actually getting 32 basis points minus 35 basis points of tracking error if you buy the ETF, or 67 basis points through the index. Aperture says you pay us 32 basis points as the management fee. We have to beat the index to earn more money.
So I get what you're saying, but I wonder why not do all this and use the ETF wrapper? You talk about the tracking error. Certainly there is that, but sometimes you can make it up with securities lending income. But in addition, ETFs are more tax efficient than a mutual fund. A chart that we have here shows that 65% of mutual funds paid capital gains versus, say, 7% of ETFs.
Yeah, just to make a point, the tracking error that I mentioned is net of the security lending revenue. So that's all the benefit, it rolled into the tracking error, and it's still negative and it's still significant. Now, as to the tax effects of mutual funds and tax effects of ETFs, it's definitely true that ETFs have a favorable tax treatment due to sort of an oddity in the tax law. How long that oddity stays in place, whether or not the IRS decides to actually investigate why mutual funds and ETFs are treated differently, is another question. But the main difference between an ETF and a mutual fund is that mutual funds are actively traded in the securities and ETFs generally are not. There are some ETFs that are actively traded, but they're complex and there's additional costs borne by the investor in order to achieve that. What would be interesting in the world is if mutual funds were actually traded continuously and priced continuously.
Like an ETF.
Like an ETF, which they could be. And the SEC would just have to approve that. And then mutual funds could be traded all day long instead of at their NAV at the end of the day.
Okay, I have a feeling that's the next thing you're going to be lobbying for then. Peter Krause, thank you so much, Chairman and CEO of Aperture Investors. Now, coming up, we dig into one ETF that looks to tackle the global climate concerns with investments in so-called clean tech. And for a drill down into all of Bloomberg's ETF content, check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet Fu. Welcome to ETF IQ. Now, for every ETF that focuses on a factor or a strategy, others are quick to follow suit. So how about a fund that covers both? Direction has a series of long-short package trades, including one that goes long economically sensitive companies and short defensive names. Direction's head of product, David Mazza, is here with us now. But before we talk to him, Eric Balchunas is going to give us the drill down into the firm's RWCD.
Thank you, Scarlett. Yeah, this is a kind of an ETF. I kind of call them package trades. They kind of do two things that would have required two ETFs or a bunch of work. You hit buy and you get a trade on. This one's going long cyclicals and short defensive sectors. So cyclicals being like tech, discretionary, defensive being like utilities and staples. So here it is. It's very new, 24 million. The fee's 45, which is pretty low for one of these package trades type ETFs. Let's look at the performance since it launched, right? And I put XLK and XLU here so you can get an idea that when you go 150-50 long short, it kind of winds up in the middle of XLK and XLU, right? So you're not, that's what you're looking at long term. Now, let's hone into 1 month, right? Or the end of, for November. Because this is when this trade actually started happening in reality. And you can see it does much better, much closer to the best performing sector here. Here's utilities here. So I think the key for this ETF is if you can get the defensive sectors to go down while the other ones go up, you really win. But you're going to get that spread here, and this is sort of a way to conveniently make it happen.
All right, Eric, still with me is David Mazza of Direction. And it feels like the duration of each of these market trends used to last months, then it became weeks, and now it's become days. Are these meant to be buy and hold investments or short-term daily trading tools?
Well, really, as Eric pointed out, they can be a bit of both. So for a long-term investor who's looking to take a view, for example, that maybe value is going to outperform growth, which we've heard multiple times over a 10-year period.
Yes.
RWVG is a great way to do that because you're overweight value relative to the growth. Now, more recently, we've seen these pockets where cyclicals and defensives have really been battling with each other. And what we've seen of late is with interest rates moving back up, yield curve uninverting, we've seen cyclicals outperform defensives really remarkably.
I want to go back to what you said about RWVG, which is counting on value outperforming growth. We can't count the number of times that people have looked for that to happen. It never lasts, even when it does happen for a bit. It always is a head fake. Should we write off this trade for the rest of the year?
Well, I think many people are now finally saying, well, value's back, right? Anytime we get 1 week, 1 month of performance, all the guys who've been hanging out saying this jump back in. In our opinion, now's not the time to dive back into value unless you get that 10-year view. And if it is, you might take a bit of pain because at some point when value comes back, I think we're going to have to see actually a market correction for that to be the case. It's going to outperform in some of the best ways it maybe ever has historically, just because of where valuations between the two sides of the trade are.
All right, so look for a correction before you hop back into value. Eric, full disclosure here, we featured a Direction ETF in our life cycle, and it's their 150-50 ESG fund.
Yeah, this is a similar, except for ESG, which I found this interesting. It's almost like you're saying ESG is a factor. Most people would buy ESG to just get rid of companies they don't want to put money into. You're actually saying this will actually increase performance, but would this be a disguised long tech, short energy kind of ETF?
No, so what's been filed for is looking at it within sectors themselves. So that's an important distinction with any type of investment, whether we're talking ESG or factors, because you're right. You don't want to get too many biases. Value right now is really all about financials versus tech, right? As financials do well, value's doing well, and growth underperforms if technology does well. Certain type of factor type exposures and more nuanced type of instruments, you want to actually look within an industry or within a sector and compare the best and worst relative to one another.
Okay, interesting answer there. We ran the numbers on ETF Go, and out of the more than 2,200 ETFs that we track here, the best performer this year is Nail. That's the ticker. It's your 3 times home builders ETF. It's up about 196% so far this year.
Yeah.
Eric, few people would hold on to this for this long. I mean, that chart looks great, but it's not like you're going to hold on to it because it's not a buy and hold investment, is it?
Yeah, it's up more than 4 times year to date over its index, basically. That's the compounding effect.
Correct.
It's lucky when this happens. How many people play this long versus just go for that short-term daily thing?
Yeah, well, so we really advocate the leverage and inverse products for tactical traders, and oftentimes we don't hear of people who have held it for longer than 1 or 2 day periods. But what you're getting at, we often is absolutely correct. We often focus on the negative impact that compounding can have when you have volatile markets. But when you have an asset like home builders that have really been in a sweet spot with consumers and with the economy hanging in here, and volatility is low, you can actually have compounding be a benefit for you.
And we've seen Direction diversify away from just the leverage company. What are your strategic plans going forward? We're going to see more plain vanilla from Direction?
Well, Direction never wants to just be a plain vanilla Me Too type operation. Our core heritage, though, is amplifying exposures, accessing the short side, and really building off of our expertise from managing leverage and inverse products, which are inherently more complicated than managing plain vanilla products. So what we're excited to do, and why I joined the firm about a year ago, is to help diversify, take our expertise, and build it into bring new areas that may seem more plain vanilla in nature, but are really just broader parts of an investor's portfolio.
I know Eric is excited to look for the 3 times ESG fund.
Yeah, are we going to see a 3 times ESG? I want to see how many people are really committed.
I don't expect that to come out anytime soon, but we are always looking for new opportunities.
All right, that's a politic answer there. David Mazza of Direction, thank you so much. We like to say the ETF industry has something for everyone, so here's a fund for those concerned about climate change who want to build a green economy. It's time to come clean about one particular ETF. Trading under the ticker PZD, the Invesco Clean Tech ETF tracks global stocks that get at least half the revenue from clean tech businesses. What does that mean? It targets companies whose products or services add economic value, while at the same time reduces the consumption of resources and the negative impact on the environment and public health. This market is expected to be massive in the coming decades. According to Bloomberg NEF's New Energy Outlook, trillions of dollars will be spent on new wind capacity, solar power, and battery storage between now and 2050. PZD has some 50 holdings, among them Schneider Electric, Novozymes, Umicore, BorgWarner, and Vestas Wind Systems. The names are equally weighted in tiers. The fund has attracted plenty of interest with assets of around $200 million, even with a not cheap expense ratio of 67 basis points. Since launching in 2006, PZD has trailed the broader U.S. market, but over the past 5 years, it's managed to keep pace with the S&P 500. PZD gets a green light in the Bloomberg Intelligence traffic light system with a notice for its unique weighting system. When you talked about ESG funds, that's an example of one that's been around for a while.
Yeah, and I know I was a little skeptical today, but I think, for investors who can stomach a little underperformance, it's a great idea. It's going to probably work. I think institutions, millennials are where you're going to see the growth, but it's still pretty small. Investing according to your values. All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time. This is Bloomberg.